Everyone wants to be a successful investor. But the truth is, most beginners make the same mistakes over and over again. And these mistakes can cost you years of progress, or even wipe out your money completely. So in this video, I'll share the 7 biggest investing mistakes beginners make, and more importantly, how to avoid them. Let's dive in. Mistake number 1. Not getting started early. The biggest advantage you have as an investor is time. Every year you wait, you lose the power of compounding. Compounding is when your money earns returns, and then those returns also start earning returns. It's like a snowball rolling downhill. The earlier you start, the bigger it grows. Here's a real example. If you invest $200 a month starting at age 25, with an average 8% return, you'll have around $525,000 by age 65. But if you wait until 35 to start, you'll only end up with about $245,000. That's less than half, even though you invested for just 10 fewer years. The lesson? Don't wait until you feel ready. Even small amounts invested early can grow into something huge over time. Mistake number 2. Trying to time the market. Everyone dreams of buying at the bottom and selling at the top. But here's the reality. Even professional investors with decades of experience rarely get this right. Let's look at the data. Studies show that missing just the 10 best days in the stock market over a 20-year period can cut your returns in half. The problem is, those best days often come right after the worst days. If you panic and sell during a crash, you almost always miss the rebound. That's why trying to time the market usually ends badly. The better strategy? Dollar cost averaging. This means you invest a fixed amount regularly, every month, every 2 weeks, whatever fits your plan. Over time, sometimes you'll buy high, sometimes low. But on average, you smooth out the ups and downs and keep building your wealth. Mistake number 3. Putting all your money in one stock. It's tempting to put all your money into a single company you believe in. Maybe it's the hot stock everyone is talking about. Maybe it's the company you work for. But here's the danger. No company is invincible. Think of Kodak, which once dominated photography. Or Blockbuster, which owned the movie rental industry. Both were household names, until they were wiped out by digital technology and Netflix. Even companies that look unstoppable today, like Tesla, Apple, or Amazon, face risks. Technology shifts, regulation changes, new competitors, anything can happen. If you put all your money into one company and it crashes, your portfolio crashes with it. The solution is diversification. Spread your money across many companies, industries, and even countries. ETFs make this easy. One purchase can give you exposure to hundreds of companies at once. Mistake number 4. Ignoring fees. Fees are the silent killer of investing returns. A 1% fee might not sound like much. But over 30 years, it can eat up tens of thousands of dollars from your portfolio. Let's take 2 investors. Both invest $10,000. Both earn 8% per year. But one pays no fees, and the other pays a 1% annual fee. After 30 years, the no-fee investor has around $100,000. The investor paying fees? Just $74,000. That's a $26,000 difference, gone to fees. This is why low-cost index ETFs are so powerful. Many charge fees as low as 0.03%. That means almost all of your money is working for you, not for the fund manager. Mistake number 5. Investing without a plan. A lot of beginners jump into investing without knowing what they're actually trying to achieve. They buy stocks because they read about them on social media. Or they follow trends because everyone else is doing it. but investing without a plan is like driving without a destination. You might move forward, but you'll probably end up lost. A good plan answers 3 questions. What are your financial goals? Retirement, buying a house, building passive income, etc. What's your timeline? 5 years? 20 years? How much risk are you willing to take? Once you know these, you can choose the right investments. For example, if you need the money in 2 years, the stock market may be too risky. But if you're investing for 20 years, you can take more risk and benefit from growth. Mistake number 6. Panic selling during market drops. The stock market goes up and down, that's normal. But beginners often panic when they see their portfolio fall. In 2020, when the pandemic hit, the market dropped over 30% in just weeks. Many beginners sold everything, convinced the market was doomed. But within a few months, the market had fully recovered, and then went on to hit record highs. By selling, those investors locked in their losses. Those who stayed invested came out ahead. Here's the lesson. Downturns are part of the game. If you believe in the long-term growth of the market, the best thing you can do during a crash is nothing. Stay calm, stay invested, and let time do the work. Mistake number 7. Not educating yourself. The final mistake is ignoring education. Investing isn't rocket science, but it does require some basic knowledge. And the good news is that knowledge is easier to get today than ever before. There are books, podcasts, courses, and yes, YouTube channels like this one, all dedicated to teaching you. The more you learn, the less likely you are to fall for scams, panic in a downturn, or chase the wrong investments. Remember, knowledge reduces fear. And when you reduce fear, you make smarter, calmer decisions with your money. Closing. So let's recap the 7 biggest investing mistakes. Waiting too long to start. Trying to time the market. Putting all your money in one stock. Ignoring fees. Investing without a plan. Panic selling during downturns and not educating yourself. Avoid these, and you'll already be ahead of most investors. Investing doesn't need to be complicated. It just needs to be consistent, diversified, and focused on the long term. If you found this video helpful, hit like and subscribe to NextGen Money Lab for more clear, simple investing tips. And don't forget to grab your free beginner's investing checklist in the description. It's the perfect guide to get started today.